Hi, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop your comments. All right, let's go for the analysis.
We are jumping right into what has to be one of the most extreme case studies in modern market microstructure, Nouveau Holding Corp, NVVE. Following that absolutely drastic 1-for-40 reverse stock split on December 15th, 2025, this stock has shown volatility that, well, it just defies any kind of conventional analysis. We're talking about a company whose market cap is microscopic. It bounces between, $1.5 and maybe $3.2 million. Yet it puts up these intraday spikes of 50, 100, even 200% on zero news.
And the reality underneath that volatility is, to be frank, catastrophic financial distress. I mean, the Q3 2025 report, it confirmed a widening net loss of $4.5 million on revenues that are actually contracting, only $1.6 million. But the real headline number is the cash position, just $900,000. That puts NVVE squarely, textbook definition, in the zone of insolvency.
And that is the tension, right? That's the whole debate here. The central question is this: does that overwhelming, catastrophic fundamental reality, the cash burn, the toxic debt, does that make Nouveau a mathematical certainty for failure? Or has the corporate action, that 1-for-40 split, created this strange high asymmetry speculative opportunity because of the, quote, microfloat environment it created? I'm going to argue that the microfloat, which is, somewhere between 1.1 and 1.3 million shares, has created technical trading dynamics that completely dominate the fundamentals right now, making it a viable, though incredibly high-risk technical play.
And I'll be taking the opposing view, that the structural insolvency combined with this continuous reliance on toxic financing means the massive dilution overhang just renders any of that technical volatility irrelevant noise. The stock is a shell. It's destined for zero, regardless of how many short-term percentage gains you can squeeze out of it.
Okay, so let's start with the immediate fallout of that reverse split. This was far more than just, a cosmetic move to stay on the NASDAQ. A 1-for-40 split, it's so drastic it necessitated a change in the CUSIP number, and that logistical shift is its key. When a CUSIP changes, it forces a mandatory reconciliation of every single lent-in shorted share across the system. And that process, it introduces mechanical pressure, and really, for my thesis, it creates extreme scarcity.
That scarcity is the entire game here.
It is. When the float drops below 1.3 million shares, the tradable supply on the order book becomes exceptionally shallow. We're talking about a liquidity desert.
It's fragile, and it's a technical vacuum.
Exactly. And that vacuum is exploitable because the force required to move the price is minimal. Think about it. A modest influx of demand, say just 500,000 shares, that represents 40 to 50% of the entire tradable supply. This is why we see those mystery rallies. The fundamentals might be a disaster, but the market mechanics guarantee extreme short-term volatility that can be arbitraged. The stock, it's not a claim on a business anymore. It's a high-frequency financial instrument of pure volatility.
I see why you're focused on the microstructure, I really do, but focusing on the scarcity of the float feels a bit like watching the smokestack on a ship that's already taken on too much water. We have to address the operational reality. We're talking about $900,000 in cash versus a quarterly cash burn of roughly $4.8 million.
Yeah.
Let's just pause on those numbers, because they define the entire risk profile. That disparity means the company has less than 8 weeks of unencumbered capital. That's the literal definition of the zone of insolvency. It proves the company is fundamentally reliant on continuous, external funding just to survive the next quarter.
Okay.
And that reliance on funding ties directly back to the price volatility you're focused on because of the dilution overhang. The reverse split didn't eliminate the company's debt. It just made the common shares more vulnerable. We have toxic financing structures out there, particularly the Series A preferred stock, which is convertible at $2.36, and then warrants covering 2.5 million shares at $3.55.
That warrant coverage is astounding. 2.5 million shares against a float of 1.2 million.
Precisely. These derivatives represent an invisible, latent supply that is mathematically guaranteed to cap any technical rally, generated by that microfloat. The moment the price moves up, these note holders and warrant holders, they're incentivized to convert and sell, ensuring that the dilution machine systematically crushes the technical play you're describing.
That brings us right to the core conflict then. The perception of a short squeeze. You argue that this structural overhang eliminates the risk, but the data around short interest is, well, it's deeply contradictory, and it's causing a lot of confusion.
It is contradictory, and we need some forensic clarity here. Standard financial portals report two completely different realities. One suggests a massive 83.6% short interest, and the other, a much more reasonable 0.4%. I cannot accept that 83% figure as representing vulnerable directional short bets.
Okay, so why not? Where does a number that massive come from if not from directional bets?
It's almost certainly a post-split data anomaly, a result of reporting lag, compounded by the inclusion of what are called synthetic shorts. These synthetic positions are used by arbitrage funds purely for hedging the huge amounts of convertible notes and warrants we just discussed. So since these positions are already covered by the underlying debt, they don't pose the same sudden explosive squeeze risk. They're patient hedgers, not vulnerable shorts caught in a rally.
That's a brilliant distinction on the synthetic shorts. And I'll concede the huge percentage is likely flawed because of the reporting lag around the SUSIP change. However, dismissing the squeeze potential entirely overlooks the actual cost of maintaining a short position in this environment.
And what is that cost?
The research points to a borrow rate hovering around 38, maybe 39%. That high rate is undeniable proof of supply tightness and a punitive cost for directional shorting. So regardless of the percentage, the mechanical presence of unresolved fails to deliver, or FTDs, in a microfloat environment is key. These are shares that were sold but never actually delivered.
So how do those FTDs translate into price movement?
They're not static. When FTDs accumulate over a certain period, Regulation SHO requires mandatory buy-ins. These aren't emotional rallies. They are mechanical, forced purchases. And in a float this tiny, these FTD squeezes cause sharp, short-lived price spikes. Those spikes are absolutely exploitable by traders betting on this specific dynamic. It's a guaranteed periodic volatility event.
But that phrasing, short-lived, that's the operative constraint, isn't it? You're confirming these are purely mechanical, non-fundamental rallies. And they're immediately resolved by the company itself or by the structured sellers.
How so?
The company has massive at-the-market facilities and shelf registrations ready to go. Anytime a technical squeeze, like an FTD buy-in, pushes the price up, the convertible note holders and the company itself issue new shares directly into that momentum. This ensures that the dilution machine constantly defeats the squeeze attempts. So sure, you can exploit the spike for a few hours, but that same spike is being used to destroy the common equity base long-term.
Which leads us directly to our second contention, this war between dilution and volatility. I come at this from market psychology. The sheer retail dominance here, almost 80% ownership, means the float is highly prone to emotional trading, momentum chasing, herding behavior. And that psychological driver can temporarily overpower the structured selling you're describing.
We're dealing with a market where the rules are set by panic and excitement, not balance sheets. And because management has so little cash, they have to wait for those technical rallies to issue stock through their ATM. The technical momentum creates the opportunity for dilution, but the dilution requires the momentum to exist first.
But the longevity of that momentum is guaranteed to be destroyed by the very design of their financing. Let's dissect the most toxic mechanism here, the death spiral, inherent in that $111,000 convertible note issued late last year.
Please, elaborate on the terms. What's the direct implication for the common shareholder?
The terms are toxic by design. This note is convertible at 90% of the average of the 5 lowest trading prices in the 10 days just before conversion. That calculation is explicitly designed to benefit the debt holder at the expense of equity holders.
Right.
The consequence is a structural incentive for note holders to short the stock. By shorting, they drive the price lower, which mathematically lowers their conversion price. A lower conversion price means they get more shares when they convert. They then sell those new shares for a profit, drive the price even lower, and just restart the cycle.
It's a perpetual motion machine of share count inflation.
Exactly. This provision guarantees that any upside momentum is systematically destroyed by the note holder's guaranteed arbitrage. It's not a risk. It's a non-optional term of the debt.
I acknowledge the toxicity of those terms. The math is brutal. But let's pivot back to the behavioral aspect. The institutional vacuum. Only 6.2% institutional ownership remains. And that lack of so-called smart money provides a counterintuitive opportunity for volatility traders.
Why would that be an opportunity?
Because traditional institutions provide stability. Their exodus means the only people left in the stock are day traders and algorithms, reacting purely to technicals, volume, price, FTD data. These participants are often totally unaware of the structural dilution mechanics until it's too late. If the only players left are momentum players, then momentum becomes the only rule that matters for short-term price discovery.
That seems to be a very costly lesson, frequently paid in full by those momentum players, which brings us to the final point, governance as a fundamental signal. You can't divorce this financial collapse from the stewardship of the management team. CEO Gregory Polesny has presided over a near-total destruction of value since the SPAC merger, yet executive incentives seem completely disconnected from shareholder outcomes.
What specific actions are you referring to?
It's the sheer prioritization of executive pay over capital the company desperately needs. The CEO got a $1.5 million payout for prior services, even as the company stated in its own filings, and I'm quoting, it expected to continue to incur substantial losses. Prioritizing executive back pay when you have less than $1 million in the bank, that isn't just a red flag, it's a declaration of who management is working for. And we also saw that bizarre, highly unusual $0.0001 stock repurchase from the CEO, a confusing transaction that just points to convoluted, self-serving equity structures. It's a structural failure at the top.
And while those facts are certainly damning from a traditional valuation standpoint, I'd argue that at this stage, governance is immaterial. In a technical distressed asset play where the valuation is already a microscopic $1 to $3 million, the market has already priced in fundamental failure and poor stewardship. The stock isn't valued as a claim on a going concern anymore. It's a leverage bet on a statistical event, a liquidity squeeze, an FTD buy-in, maybe a lowball acquisition. The governance failures are a sunk cost already in that tiny valuation.
But the governance issues manifest directly in the balance sheet. They accelerate the dilution. I mean, consider the settlement with Rhombus Energy Solutions. NVVE had to agree to pay $2.4 million for chargers. With only $900,000 in cash, that litigation drain forces them to immediately seek out more toxic financing. So the governance failure translates directly into capital structure instability, forcing them right back to the toxic debt market that fuels the whole dilution cycle.
And that instability is the engine of the volatility, I argue, creates opportunity.
And the driver of the eventual collapse, I argue, is mathematically inevitable.
This discussion, it really synthesizes the inherent dichotomy in the NVV case. On one side, we have the crushing mathematical certainty of dilution and insolvency. It's all supported by the Q3 2025 financials, the cash burn, the toxic debt. It's a classic short thesis backed by, rigorous arithmetic.
And on the other, you highlight this exploitable, high volatility environment created by the post-split microfloat, the high retail dominance, and these mechanical forces like Regis HO and FTDs that generate periodic, undeniable price spikes.
My final point just remains that while the fundamental outlook is undeniably grim, the unique post-split structure has temporarily, functionally divorced the stock price from operational reality, and that creates these narrow windows for aggressive, speculative gains, provided a trader can navigate the extreme fragility. It's an exercise in technical pattern recognition in a failing vessel.
And my conclusion is that the structural risks, the guarantee of share count inflation via death spiral financing, and that razor-thin cash runway ultimately represent an asymmetric downside risk that overwhelmingly overshadows those fleeting technical rallies. The company is fundamentally bankrupting itself via continuous dilution just to stay listed, and common shareholders are footing the bill for that survival mechanism. The NVVE case study offers a chilling, complex look into what it takes to navigate distressed microcaps, demanding an exceptional understanding of both financial fundamentals and intricate market microstructure.
If you found this video interesting, don't forget to subscribe to the Stock Market Palantir channel for more. Thanks for watching and see you next video. Bye-bye.